Hey everyone, welcome back to Corporate Decoder, the place where we turn confusing corporate reports into something you can actually understand. Today, we're diving into the EA Series Trust, specifically looking at the Research Affiliates Deletions ETF. Don't worry, it's not as scary as it sounds. Think of it like this: we're checking up on an exchange-traded fund or ETF that focuses on companies that have been deleted from major indexes. Sounds a little gloomy, right? Well, sometimes there are hidden opportunities in unloved stocks, or maybe not. Let's find out what's going on under the hood. So, what is this fund exactly? It's an ETF with the catchy ticker symbol NIXD, which attempts to mimic the Research Affiliates Deletions Index. Basically, this index includes companies that have been kicked out of major indexes. This fund is relatively new. It only started operating in September of 2024. Let's talk about costs because that's what everyone wants to know. For every $10,000 you invest, it cost about $3 during the reporting period. That works out to be 0.09%, a fairly small expense ratio, which is the fee the fund charges to manage your money. Now, for some key stats, as of the end of the year December of 2024, the fund had about $35.6 million in net assets. It holds about 139 different stocks. The fund's portfolio turnover rate was 4%, meaning they didn't trade the underlying holdings too often. Where is this fund putting your money? The biggest sector is consumer discretionary, making up 19% of the fund's assets. That's your non-essential spending like entertainment or eating out. Next up are financials, healthcare, information technology, and communication services at about 13% each. Real estate isn't too far behind at 11.8%. Let's peek at the top holdings. At the very top is Lumen Technologies, making up almost 3% of the fund. After that are Telephone and Data Systems, Lumentum Holdings, and Affirm Holdings. You can see how it's allocated to the top holdings. Okay, now let's dive into the actual investments. This is the fund's portfolio. The biggest chunk, almost 87%, is in common stocks. Real estate investment trusts, or REITs, make up another 13%. The rest is in very short-term investments, less than 0.05%. Looking closer at the common stocks, we see a lot of familiar names. Spirit AeroSystems, the company that makes airplane parts, is in there. Then there's C.H. Robinson Worldwide, a logistics company. Lumen Technologies, the one we talked about at the top, shows up again. We also see a bunch of retailers like American Eagle, Foot Locker, and Gap. There are also some electric vehicle companies like Lucid and Rivian. You can start to see a trend here. The fund seems to hold some companies that have faced some challenges. Let's jump to the financial statements. First, the statement of assets and liabilities. At the end of December, the fund had about $35.6 million in total net assets. Now onto the statement of operations, the fund's profit and loss statement. The fund generated about $489,000 in investment income, mostly from dividends. After deducting expenses, including the advisor's fees and the amount the advisor reimbursed, the fund had a net investment income of $480,000 for the period. Looking at the statement of changes in net assets, the fund started from zero. Remember, it only launched in September. Thanks to investment income, subscriptions from investors, and after accounting for distributions paid out, the fund ended the period with that $35.6 million we talked about earlier. Finally, the financial highlights. This is a neat summary of key metrics. The fund's net asset value, or NAV, started at $24.90 per share. After everything was said and done, it ended at $25.65. This led to a total return for the period of 4.43%. Keep in mind that is not an annualized number. The expense ratio was a tiny 0.09%. Now let's touch on something important: related party transactions. Basically, this section tells us about the relationship between the fund and its advisor, Empowered Funds. The advisor manages the fund, oversees its operations, and makes sure everything runs smoothly. They're responsible for most of the fund's expenses, but they get paid an advisory fee for their services. For the reporting period, the advisor actually waived a portion of their fee, saving the fund some money. Let's check out securities lending. This is where the fund loans out its securities to other institutions. However, the fund did not engage in securities lending during this period. If they did, they'd receive collateral in return, which they could invest to generate extra income. During the period, the fund purchased securities worth $1.2 million and sold securities worth about $1.1 million, excluding short-term securities and in-kind transactions. There were also some in-kind transactions associated with creations and redemptions, where investors exchanged shares for securities. The fund paid out $493,692 in distributions to its shareholders during the period, characterized as ordinary income. Finally, the fund's management checked for any important events that happened after the end of December. They didn't find anything that would significantly change the numbers or disclosures in the financial statements. The independent trustees are paid by the advisor. The board met in June of 2024 to talk about the advisory agreement between the trust and the advisor and how they came to an agreement. The trustees looked at a lot of factors, including the service the advisor provides and that they oversee the trust's administrator, transfer agent, and custodian. They stated it was a bit pricey considering they don't have other similar ventures. The board voted in favor. This part doesn't apply here, so let's keep moving. This also isn't applicable, so let's keep moving. There were no changes to the procedures for shareholders making suggestions to the board. The president and treasurer said the company's disclosure controls and procedures were effective. There were no important changes to internal financial reporting controls. Now, let's step back and take a broader view. This ETF is focused on a very specific niche, companies that have fallen out of favor. Whether this is a good idea remains to be seen. On the strength side, the expense ratio is super low, making it cheap to hold. The portfolio turnover is also low, suggesting a buy-and-hold strategy which can be tax-efficient. However, a big risk is the fund's focus on beaten-down stocks. It's possible that some of these companies are down for good reason and may not recover. Also, with only $35 million in assets, the fund is still quite small, which could make it more volatile and harder to trade. Overall, the Research Affiliates Deletions ETF is an interesting but potentially risky fund. It might be worth a small allocation if you're a contrarian investor who believes in second chances, but it's definitely not a core holding for most portfolios. Thanks for watching. If you found this breakdown helpful, please hit that like button, leave a comment, and subscribe for more corporate decoding. Until next time.